The precipitous decline in oil prices has been a double-edged sword for the U.S. economy. For many motorists, it means the lowest gas prices in decades. But for some U.S. oil and gas producers, the news isn't so good. As many as a third of them are facing potential bankruptcy. WSJ energy reporter Bradley Olson joins us from Houston with all the details. Hi, Bradley. Thanks for being with us.
Hi, happy to be here.
So, Bradley, three major banks, Morgan Stanley, Goldman Sachs, and Citigroup, are predicting the price of oil could drop to below $30 a barrel. Are U.S. companies prepared for that?
It's hard to say. A lot of them are still in denial. A lot of them are still trying to boost production or show that they can really last in the downturn. And so that's become a problem. That they continue to pump, and that kind of works against all of their collective best interest. It's a bit of a strange scenario.
And yet in your piece, you show that some companies feel they have no choice but to keep pumping oil in order to pay off interest from all the debt they've taken on, correct?
That's exactly right. I mean, one of the things that you'll find about the shale boom is that it was tied very closely to easy money. Those things went hand in hand. And so a lot of these companies worked fine at $100 oil. Mm-hmm. They had easy access to capital, and they used it to drill, and they didn't always make money, but they were always able to produce, and investors really liked the growth that they were able to come up with. But what's happening now is the companies that swallowed too much debt before these prices fell really have nowhere to turn, and the only way that they can get cash, they can't go to the capital markets, they can't go to Wall Street, and so they have to drill wells. But what that keeps doing is it keeps the price down. It makes the price so that it doesn't really have a chance to rebound.
So can you explain then how some companies, because the news isn't bad across the board necessarily, how some companies are benefiting from smart price hedging?
That's right. There are some companies. One example is Pioneer. It's a company that primarily drills out in West Texas. And last year, there was a brief rebound where prices were above $60, and a lot of companies booked hedges and locked in prices for this year at that time. And so those companies are doing just fine. I mean, Pioneer just had an equity issuance where they were able to sell $1.5 billion in shares. And so you're seeing kind of a splintering into what I would call haves and have-nots in the oil patch. And the haves are doing fine. I mean, they don't like $30 oil. Mm-hmm. Nobody in the oil industry likes $30 oil, but they're definitely going to be able to survive, well into next year.
So they can weather this. But in terms of some of the smaller guys, have a lot already started declaring bankruptcy?
Well, there are at least more than 30 right now, according to the law firm Haynes & Boone. So there have been a significant number of bankruptcies. The problem with bankruptcies is even that won't slow production. Basically what happens is there's a certain cost for drilling, and let's just hypothetically say it might be $40 or $50 a barrel for a given shale operator. And a lot of that break-even price cost is due to the debt that they have. But let's say they file for bankruptcy and the debt gets wiped out. Well, all of a sudden they can make money producing at a lot less money. Mm-hmm. And so whoever the new owner is has an incentive to keep drilling. Mm-hmm. That's the problem, is even bankruptcy may not slow down the shale boom.
The drilling keeps going. Now, what kind of an impact, Bradley, could this have on the U.S. energy sector as a whole? And what other industries might also be impacted?
Well, we've seen some bleed over into things like railroads. They obviously depend or have depended in great deal in recent years on oil shipments from areas that don't have a lot of pipelines, like in North Dakota. So it's definitely hit, railroads and other places like that. But I think that overall in the oil industry, it's going to, bring deals. It's going to bring consolidation and reshaping of the industry. And I think one thing that may happen that a lot of people aren't anticipating right now is that once prices swing back up, it's going to be a lot harder for these guys to grow and boost production, because a lot of the workers that they have laid off have gone to other places.
Right.
These sort of oil hubs that sprung up all over the U.S. have sort of ramped down already. So ramping back up is going to be really hard.
Absolutely not good news. And speaking of oil hubs, you're sort of at the epicenter of all this there in Houston. What is the mood there?
Oh, it's quite dire. I think a lot of, even you might say, a gallows humor can set in among people about the oil price and how low can it go. And I think that, the mood is difficult when there are just thousands and thousands of people that are being laid off. I mean, BP announced today, I think, 4,000 additional layoffs, including plenty in the U.S. And so I think everybody's just sort of waiting for the shoe to drop wherever they work.
All right, Bradley Olson, thank you so much for that.
Thank you. I appreciate it.